Please welcome to the stage Amelia Ibarra, GM and SVP at SaaStr, and Jason Lemkin, founder and CEO at SaaStr.
Hello!
Anybody having fun?
Everyone vibing? All right. Welcome to SaaStr Annual, whether this is your 10th one or your first. We just wanted to help get you a little quick start on the day, what to expect for the next 3 days. There's zip lines, there's brain dates, there's like a lot going on. So we just wanted to help you guys get a lay of the land so you can make the most out of attending SaaStr Annual 2023. So real quick before we get into it, is it their first SaaStr? Show of hands. Oh, we got a lot of new. Welcome to SaaStr. And who's a returning attendee? Fun. Well, welcome back and welcome home. There's a lot to see at SaaStr this year, so we'll be your field guide experts for the day. There are 2 hangars. You've probably already been in them, talked to some of our really lovely sponsors. There's campus maps if you need them, but the hangars are right behind you, so they're hangars west and east. They are literally the center of everything. So if you're looking for food, activations, happy hours, it is all in those 2 hangars right back there. The Food and Wine Fest tonight is going to be back there in those 2 sponsor halls.
Okay, when does that start?
Yeah.
When does the Food and Wine Festival start?
When does it start?
What time?
It starts at 5.
5?
Yeah.
Okay, 5. Okay.
Yeah.
And there'll be Napa-style wines?
Napa-style wines. We're going to do like Napa-style bar bites.
Okay.
A
All right,
jazz
sounds
band.
good. Okay, good. Okay, so that's 5 o'clock here in the hangars on site, right?
5 o'clock here in the hangar.
Okay,
Yes.
got it.
Yes.
Okay, keep going.
What's that?
Keep going.
Okay.
Yeah.
I know a lot of you already have like lunch and stuff. Lunches will all be back there, as you guys have already noticed. Coffee's back there. Anything you need is pretty much in those 2 hangars. So if you're looking for it, check there first.
Okay, and in the back of that one, Hangar East?
Yes.
If you haven't seen it, there is power in the co-working space, right?
There's power in the co-working
There's power
space,
if you need to
yeah.
charge. But like only half the desks have power, right? So look underneath the ones. They all have plugs, but only the ones that are close to the but half of them do have power.
They do have power,
They do have
yeah.
power. Okay.
So if you need to charge up, that's a good place to do it. I know some sponsors also have like those portable batteries if you need some.
Okay.
Yeah. Good place to power up. Brain dates. I know some of you have already done some morning brain dates. Those are in the blue building over there with a big banner on it. Brain dates are such a great way to network. We'll talk about it a little bit more, but we highly recommend doing a brain date, joining one, hosting one. It's like the best thing you could do at SaaStr.
Okay. And you'll get to it. But some folks spend the entire SaaStr Annual and SaaStr Europa just in brain dates, meeting people one-on-ones, one-on-twos, one-on-fours.
Correct.
You can sign up in the mobile app, but if you haven't, you can just walk there and they will help you sign up, right?
They will help you sign up. Yeah, just walk into those doors, look for the Brain Date Lounge team. They will help you book a brain date.
Okay, good.
Yes. New this year, for all my new folks, it's not new to you, but just new for everyone this year, we do have founders and VC-only lounges. So right past those big buildings, you'll see our founders lounge, you'll see our VC lounges. If you're a founder or a VC, it is gated.
Yes.
Yeah, so they will check your badge, and if you're one of those folks, they will let you in.
Yeah, some folks, obviously you're going to meet a lot of people when you're here, but a bunch of folks said I want an area where I can just meet other founders. So on the other side of the East container, there's a founders lounge that Rome sponsored.
Yeah.
And so the brain dates are great, but if you just want to chill and meet other founders, pop in there.
Yeah, pop in there. New this year, also in the afternoon, we've got our SaaStr Royale. So if you want to try gambling, there's no money involved.
No money? There's SaaStr bucks?
There's SaaStr bucks, only SaaStr bucks.
Okay.
And bragging rights. And then last but not least, you guys have probably seen our lovely container park. That's where you can, in fact, ride the zip line. Okay, I know a lot of folks, it's a little confusing because we have so many sessions, so we put it all into the SaaStr Events app for you. If you haven't downloaded it yet, please do. It's just called SaaStr Events on either iTunes or Android. It really helps you check in. You can book a brain date on it. You can also start chatting on it. So you guys have probably seen our QR codes kind of like splayed throughout the entire campus. Just download the app, scan that QR code, and you can start chatting. Super handy. So yeah, if you're wondering what these crazy QR codes are, these are accessible.
I'm wondering.
You're wondering,
I did
right?
not
They're
know what the
everywhere.
QR They
Yeah,
seem
they're
to be
everywhere.
everywhere this year. What are they?
Yeah, they're everywhere. They are powered by new Expensify. The lovely folks at Expensify helped us make a chat app for SaaStr Annual. I know a lot of folks kept asking us, how can I chat and communicate with other attendees while I'm here outside of brain dates? So you can do that in the SaaStr Annual chat. So there's two types of rooms. There's kind of like general rooms, like social and announce. So if you join those, there's already a lot of you in there chiming in of where you've flown in from, who you've talked to this morning. So you can go into those. And then you'll see them right before each session as well. So if you go into each session's QR code, you can actually chat with the speakers. So highly recommend that you do this. So be on the lookout for those. And then tomorrow, if you guys keep your lunch receipt, and you join the app, Expensify will literally give you $20. So keep your lunch receipt.
Cash? A $20 bill?
$20. They'll give it
$20.
back to you. Yeah.
Okay, that's pretty good.
It's a pretty good deal for minimal work. Okay. If you have not yet, please do sign up for a brain date. We've done these, I don't know how many years in a row now. A few. These are our one-on-one and group mentoring sessions. So how this really works is, again, go talk to those lovely folks in the hangar. They'll help you get set up. You walk up to them. You can join a brain date. There's a lot of really great topics in there, everything from AI to PLG to marketing to sales. Lots of really great folks hosting and joining brain dates. So good way to do it, especially in the mornings. I highly recommend doing the morning ones kind of before the content gets too full throughout the day. Really helpful to join those morning brain dates. Okay, today, we talked about it a little bit, but today, stick around.
Hold on, for the brain dates, because they started early today at 10. If people come early tomorrow, what time do the brain dates start?
They start at 9 a.m. tomorrow.
Okay, so if you're not, some of us are early birds.
Yeah.
Hello, Jacob. If you come at 9, is there stage content or just brain dates?
There's just brain dates in the morning.
Okay, but it's a mellow time. If you want to meet, some folks want to meet the maximum number of people possible. So come at 8:45 and do some brain dates at 9.
We'll be open. There'll be coffee. There'll be breakfast. Yeah.
Okay.
Come for a brain date.
Okay.
Okay, today's big evening activities, we've got happy hour starting at 3:30 in the hangars, followed by the first ever SaaStr Wine and Food Fest.
Okay, yes.
It'll be fun. And then tomorrow, I know this is the moment everyone's been waiting for, or maybe just me, cheat codes will be playing right here on stage.
Right here on stage?
Right here on stage.
Okay, will it be loud?
It will be a little loud.
Okay, it'll be a little loud. Okay.
It's going to be a party.
Okay.
Let's be clear.
Okay. Sounds good.
It will be a party. If you guys haven't heard of them yet, load up their Spotify or their YouTube.
Go on Spotify. How many plays do they have on Spotify?
It says 6 billion.
6 billion plays on Spotify for cheat codes?
I've listened to it a lot, though, so it might have gone up a little.
Okay. All right.
Yes.
Okay.
We'll have a really great opener tomorrow. Don't miss it. I know a lot of people come to the big party. We kind of clear the room out. We turn it into a party. It's a really fun time. So, yeah, hope to see you here.
Is it okay to dress as one of these cheat codes, or you think, or how do you come out on a little bit?
Yeah.
You can pick one of these.
Yeah,
vibes?
bring your best fit to the big party.
Okay, I'm going frosting tonight.
It's a good plan.
Okay.
Friday, to close everything out, stick around. We will have a beer garden out in our container bar. Also, the first beer garden at SaaStr. Everything's new.
And we'll do our when does our final AMA start?
Your final AMA is, I think, at 3 o'clock. Yeah.
3 o'clock.
Yeah,
okay.
yeah.
So for folks that want, we have it. We do. I lead it to the extent I can be helpful, but we do like a 2-hour final AMA. Grab a beer from the container park. You can hang out here, and we will answer any last questions until we collapse or they kick us out. So.
Yes. Exactly. Cool. All right. A few pro tips. If this is your maybe first SaaStr.
Okay.
Okay. There is a bit of a scavenger hunt going on. So
I did not know this.
Yeah, for things like cold brew coffee, ice cream, popsicles.
I see.
Yeah, a lot of our popcorn, a lot of our sponsors have specialty foods and items going on at their booths. I've seen like on-demand swag items.
Yeah.
I've seen games out there, headshots.
Yes.
A lot of things out there.
A lot of activations.
A lot of activations.
A lot of activations.
Yeah, so go visit all of them. If you're looking for some of those specialty food items, sponsors have them.
Yeah. Okay.
We also this year have a not-so-secret speakeasy. So if you were here last year, we moved it. Fun fact. So it is in a different place. So it is still a secret. But if you do find it, kudos to you. It's sponsored by our friends at Vonage. There's like secret snacks in there. There's like other things in there.
Got it. There's slushies. There's cocktails.
There's slushies, yeah.
Classic speakeasy stuff, right?
Yeah. Okay. Alcoholic slushies.
Okay.
There's also other things in there.
That's good.
We did, it is 3 days, so definitely pace yourselves. I know everyone got really dressed up for SaaStr. All of you were excited at like 7 a.m. to come into the gates like it's the Disneyland or the Eras Tour, which we're loving. But definitely pace yourself. I know it's a long 3 days. It's a lot of walking. So there are shuttles you can take. There's the pedicabs you can take. They'll help get you around the campus.
Okay, and just those pedicabs and shuttles, you can just hail one if you want to ride.
You can just hail one, yeah.
They'll take you anywhere on the campus, or if you want, you can just sit on them and relax and just take a loop, right?
Yeah, you can just take a loop. Yeah.
Okay,
just for fun.
don't be shy. Grab any of them,
Yeah,
right?
they're there for you guys.
Okay.
Like we said, coffee's all throughout the campus. I know sometimes people tweet us and ask us where the coffee is. It's literally everywhere. There's some at the back of this stage. There's some at the back of the next stage in the expo. There's some out in the midway. So yeah, there's coffee literally everywhere if you're looking for coffee.
Okay.
Lunches, as you guys have noticed, are in the cantinas. And then, yeah, like I said, don't miss out on the big party. If you have not yet, our wonderful registration team gave you the SaaStr bucks.
Yep.
You can redeem them in the swag store. So in this big building right behind you guys is the SaaStr swag store. Take your SaaStr bucks there. You can spend them. There's some really fun, like limited edition swag in there. So if you're wondering where people got the SaaStr swag, that's where.
What if you want more SaaStr swag? You want even more SaaStr bucks? How do you get them?
Great question. So glad you asked.
Oh, you have a slide on that?
It's on you, yeah. So you can earn more SaaStr bucks at the casino.
Oh, at the casino over there, just in the outdoor area to the east
right
of the hangar east. At the casino, you can earn more SaaStr bucks.
You can earn more SaaStr bucks. So if you really wanted like more than one item, or
some folks want to take like 6 T-shirts home for their family and kids. Go to the casino.
Go to the casino.
Okay.
Yeah.
It's the only casino where you only win.
That's
correct. A good casino.
Yeah. There's no downside.
Yeah. Okay.
All right, everyone. So thank you so much for joining us. Anything you want to add for anyone returning to SaaStr?
Maybe slightly related to this. We have, and some folks, there's so much going on here, and we have, Amelia does her best to get the communications. But one thing that has helped a lot of folks is we have a Meet as a VC program. And if you didn't see it, it's too late to sign up on site. You have to do it ahead of time. But there's a form, you fill out your deck and your ARR and all this kind of stuff, and the VCs in turn, and we do some lightweight matching, and I think we had close to 200 founders that opted in, about 200 VCs,
That's right.
And it's pretty good. And there's other ways to meet investors here, but for folks that are here, once we recover from this event, we're going to continue this year-round now. So anyone that is here that is a founder can opt into this program monthly, year-round. So look for emails for us. And if you want to, especially have a great month in October, November, hit a big milestone, add AI as your new TLD or something, opt into the Meet a VC program. We're going to, instead of running it before each event, for anyone that comes to annual or SaaS Europa in London in June, we will run it year-round. So
Correct.
It's an experiment, but I think we'll get a lot more engagement. And we have, honestly, we have more VCs. I mean, VCs are picky. It's not like everyone's going to get funded, but we have more VCs that want to meet founders and meet them through the program. So look for your email. And if you didn't sign up for it, there is a Meet a VC link on the SaaStr annual website. Is it hidden or is it there?
meetavc.com.
Okay, write this down. meetavc.com, and as long as you have a ticket to this annual or the next one, you can participate.
Yeah.
And we will get this. We've done this for 7 years, but we're going to productize it so to do more matchmaking going forward. That was my main ad.
We made it super easy.
Okay. Cool. All right, so we're going to take like a 3-minute break and then bring David Sachs out for an encore appearance at SaaStr.
Absolutely.
Today's a lot of the legends of SaaStr, right?
A
lot of folks' favorites.
Monday.com,
We got Monday.com. We got Sim of Datadog back.
Mark
we got
Roberge.
David back. Mark Roberge, right? So it's good. Good. All right, we'll be back with David in just a minute. Thanks, everybody.
Thanks, everyone. Enjoy SaaStr.
As the name craft suggests, we think that venture is a craft business. It's kind of artisanal. It's just us working with founders. The talent are the entrepreneurs. Once you know that there's a market there, you need to basically go all out to win it. The question is, what's that one feature, that one critical feature that's going to kind of launch you? One of the common denominators of the whole PayPal mafia is just how phenomenally determined everybody was to make that company a success. When we sold Yammer back in 2012, $2 billion was what success looked like. There's surprisingly few VCs who actually have had that experience building companies as the CEO. There's been a regime change. Rethink how to get efficient about everything. So when we come out of this period and we start having tailwinds again, then you pour on the gas. Technology doesn't stop developing. There'll always be new things that are very hard for us to imagine today. I want to work with the founders who feel compelled to do it.
Please welcome to the stage David Sachs, founder and general partner at Craft Ventures, and Jason Lemkin, founder and CEO at SaaStr.
All right. Can you guys hear us okay? All good? David, thank you for coming back to SaaStr. Really appreciate it.
Great to be here.
We have been doing these for 9 years.
Amazing.
And, you were kind enough to come out of the blue to the first one, not knowing what SaaStr Annual was. So it is good to have you back.
Yeah.
Well, good. A lot. First of all, guys, we will try to, there's a lot I want to get through with David, but we'll try to save a few minutes for questions at the end, so think of one or two. But I bet we'll use up most of our time. So much I want to chat about. Even, frankly, I want to learn in a few minutes down the road why you even have the enthusiasm to start another company, right? I feel like I'm high energy, and I could barely keep doing what I'm doing.
Yeah.
So I want to get there, but in order. But before, let's talk, because we've both been doing this for a long time, AI.
Yeah.
First of all, from a craft perspective, so, craft's a big fund now. What's your assets under management, $1.5 billion?
We're at $3.3 billion under management. Yeah.
That was fast.
Yeah.
Is that a record, over $3 billion?
I don't know if it's a record, but yeah, it is pretty fast. Now, half of that is in new funds that we haven't deployed yet. So.
Okay. That's a topic we come back to. But okay, so $3.3 billion. When you guys are talking each week, and craft is still very B2B focused, right?
Yes.
Majority B2B. How much of this convo is about AI? Is it all AI? Does it have to be AI first?
It's about 80%.
80%.
Yeah.
Okay. And if I want to just come to you, what's that?
For new stuff. Obviously, we have a large portfolio of founders that we need to keep servicing, and most of that is not AI. It was pre-AI.
Right.
But in terms of looking for new ideas, I think the team is spending 70 to 80% of their time looking at AI.
And if I had the world's best payroll app, could I get a meeting at Craft?
Yeah, absolutely. That's the other.
I'm not being
30%.
facetious. It's
No. It's the issue is that one of the questions all VCs ask is why now?
Yeah.
So there is a tendency, if you think about every major platform shift as kind of a pond, and the pond is kind of stocked with opportunities, it will get fished out over time.
Yeah.
The best opportunities over time will get taken. There's always this question of why is this idea still available to the founder to be exploited? And, it's been, before AI came on the scene, it was, roughly a dozen years since the last really big platform shift. We had a couple. We had cloud, obviously, has been huge, and then mobile. There was also social, although that mattered a little bit less in B2B. So there was a sense that SaaS was getting a little bit long in the tooth as a wave, kind of multi-tenant SaaS, and we needed something new to come along to kind of reset, kind of restock the pond with opportunities. Yeah. And I think that's AI. At least that's the way most VCs.
What do you guys, and what has made your jaw drop, or what gets the team excited for reals, right?
Well, we have seen a bunch of cool demos in AI that have been pretty impressive, although a lot of them are more prototypey. I would say that we've kind of divided the AI opportunities into 3 buckets. There's infrastructure, which is super hot, and you're seeing massive rounds get done at super high valuations. Ultimately, my view is that infrastructure is going to be owned by the big tech companies, and those mainly are plays for a good M&A exit.
Yeah.
Second bucket is co-pilots, and I think this is the area where actually startups, new founders can start new things that the big companies really aren't going to go after. I think there's going to be a co-pilot for every professional job category. You've already seen a bunch for lawyers, doctors.
Explosion
I think,
co-pilots.
architect. I think there'll be, again, co-pilots for everything. And then there'll be co-pilots for horizontal job functions, marketing, sales, so forth. Third category is pre-AI SaaS apps that get turbocharged in their value by adding AI functionality. Doesn't mean they're going to be like the deep, the sort of a foundation model. It's more like they get to exploit all these new AI APIs to make their product better. We've seen like the Killer Notion AI demo where it auto-completes everything. Yep. Our portfolio company ClickUp just released some similar functionality. I think that apps like Gong or Chorus are going to be turbocharged with the ability to analyze all that conversational intelligence that they're recording. So I do think there'll be a lot of, again, pre-AI SaaS apps that just get a lot better because of this functionality.
Yeah, no, I'm with you, but it's interesting. I think what you said, maybe to help founders, is really the moment in time. Craft's got over $3 billion under management. You're spending 70 to 80% of your time on new deals on AI. But a lot of the stuff is just past demoware, right? So it's an interesting mismatch where unicorns have been reborn here.
Yeah.
But we're getting very excited early.
We're planning on deploying our current funds very slowly.
Slowly.
So just because it's what we're spending, again, 70 to 80% of our sort of search time.
Yeah.
And again, we spend a huge amount of time just helping our current portfolio. But in terms of the search for new ideas, just because it's 70 to 80% of our time doesn't mean that we're instantly going to be like piling. It's going to take a while for this stuff to play out. We've only made, I'd say, a couple of, we've made a few seed investments. Seed checks are a lot easier to write right now. I think we've only written one or two, you could call them like Series A type checks.
One or two this year.
Yeah.
Yeah. So that, and let's take 2021 out of the equation. How does that compare to your average pace, one or two?
I think that things right now, they're going back to more the 2020 and 2021 were simply a bubble.
Yeah.
It was a massive bubble, especially the second half of 2021. Valuations were crazy, rounds were crazy.
It was worse because actually the metrics were already cratering in 2021. But we kept investing until New Year's Eve.
I didn't, to be honest, there were a lot of companies that we saw that actually had very good metrics in 2021. I didn't see the metrics start cratering until mid-2022.
But I think the macro, like if you look at Shopify and Zoom, they had already reverted to normal.
Yeah.
Right? There's this bubble we were ignoring the fact that we'd returned to the normal world quicker than we thought.
Yeah, so you're right. So the businesses that got accelerated by COVID were already reverting to the mean. I think that in terms of the financial markets, everything peaked in November of 2021. That's when the Fed started turning really, really hawkish and indicated that they would be raising rates, but the rate hikes didn't start until about March. And so Q1 was still this like last gasp of people able to get rounds done, maybe not quite as good as in Q4.
It was nervous, but it was happening.
But it was still happening. I would say like by Q2 of 2022, it was nothing but like a falling knife. And then what I started seeing is, but my portfolio companies, I think, were still hitting their forecast by and large. It wasn't until the second half of 2022 that every board meeting I was at was like a exercise in reforecasting down. And that was the part that was a little bit surprising to me, is how much the Fed's crazy loose money ZIRP policy was inflating the metrics of like every company all the way down to kind of early stage software companies.
Yeah. Well, let's come back to that. But so just to be technical and venture, because I think it's still an opaque world for founders.
Yeah.
So it is interesting, even if it's sometimes boring to you and me. 2 deals a year, right?
I think the last year was a really slow period. I think.
Yeah.
I would say that our expectation moving forward is that we will do, call it 1.5. I'd say 1.5, which means deals per quarter.
Okay.
So
1.5 big A's.
Yeah, that's like leading a Series A or Series B. So call it 3 every 6 months.
Yeah.
Or 6 a year. So I guess that's 1 every 2 months. And then seed's a little different. I think we can do like a couple of seeds a quarter, maybe even 2 to 3 seeds a quarter.
Yeah, and that's, just thinking about it for a moment for founders here, even for you and me, venture math's crazy. To think about having $3 billion under management and doing 6, you might intuitively as a founder think it's got to be 60, or like, it also means the odds, as simple as fundraising seemed in 2021, actually mathematically the odds are tough, aren't they?
Yeah.
Do you guys know, do you know how you model the attrition from seed day? Have you guys modeled that?
Yeah, I mean, we're still trying to figure that out, I guess, in terms of like giving you a precise numerical answer, but I can tell you that it's based on like a feel thing. It's really changed. I would say that 2 years ago, I would say like every seed round looked good because the graduation rate to Series A was so high. And so, if you're paying like 15, 20, even as high as like a 30 cap on a seed round, and it was graduating to a Series A round at a $60 to $100 million valuation, which was very common in 2021, you felt like you were getting a discount by investing in almost every seed round that you did. And there were a lot of seed rounds basically based on this thesis, which is we're just going to arb the fact that
there was a lot of arb going on.
Yeah, like we know this company will get a Series A round, so we're just going to invest in the seed round. Well, I would say that the mortality rate on seed right now is very high. I think it's probably going to be like 80%.
That's my gut, about 80, right? Yeah, I did 20 VC the other day, and Frank Rotman from QED's on, who's been doing fintech a long time. He said their traditional model was 80% graduation, and kudos to someone that's very metrics driven, but that's, as a founder, if you're planning on that today, you're crazy, right?
I think in 1 year, I think the expectation should go from about 20% attrition to 80% attrition.
Yeah.
So seed is no longer a bargain. It's actually like pretty tough.
For investors, seed stuff?
Yes, that's what I mean, yes.
Because you're inherently overpaying?
Well, you might be overpaying. There's a lot of seed funds, and so I'm no longer convinced that seed is particularly like a bargain in terms of that part of the market. In fact, I think probably Series A or Series B is a better place to invest. I think the question is always the trade-off between proof and how much proof do you want as an investor versus the extra valuation that you have to pay up for that. And I think that a couple of years ago you'd have to pay up a ton for that incremental proof because it just it felt like the valuations would just hockey stick as soon as anything seemed to be working.
Yeah.
And now I think investors are more skeptical, and I think you don't have to pay as much to get a little bit more proof. And so I think it's okay to wait, basically, just incrementally.
Yeah, if you can't, I mean, that's the paradox for all of it for founders. You would wait if you could.
Right.
Right? When I started, the lesson I was taught is from seed to A, the valuation needs to at least double, but ideally triple, not to be fancy or to look good on paper, but to justify the risk.
Yes.
Because if you have enough money, and Kraft has enough money, you might as well wait. Like, I'll pay 2x the price for a tenth the risk. That's the biggest bargain in the world, isn't it?
Yes, I think that's right. So if it is an 80% mortality rate from seed to Series A, Series A's need to be 5 times. Basically.
The math just does the math doesn't work, right?
It doesn't. But and I think there has been a correction. So the correction evaluation started with the super late stage stuff, because what happened is the crossover investors who had come into the market, like the Tigers and so on, they just got their faces ripped off. So they basically just got out of the market. And so the super late stage rounds is where liquidity just dried up. And then it started trickling down. And so, first Series C was hard, and then Series B got hard. I mean, everyone who's kind of around earlier can look forward and see, oh, wait a second, there's no one to market my deal anymore. I better be really conservative. Yeah. And it trickles all the way down. But seed obviously is the last round for it to trickle down to. And I'm not sure it's fully corrected.
Yeah, I don't. I think folks here may feel different. I actually think here in the virtual Bay Area, where you have multiple successful founders with lots of money, I don't think it's corrected at all for the haves.
Right.
For the ones with the right resumes that came out of Stripe or came out of Yammer or came out of wherever, there's no impact. Yeah. Right? There's still a surplus of folks who, in many cases, are gentle people, investors, and they don't care, right? Yeah. All right, 2 things I want to hit on this slide. Maybe we lost it up front if we could bring it back. There's a lot. But these are things I know you've thought about. So we talked at the beginning, 80% of crafts thinking about AI. Other things that got exciting and maybe are less today. Let's talk about the second one first. Low margin SaaS, right? And you've done plenty of stuff in fintech and combination over your career. I still get confused when I meet with a founder with a 30% or 40% margin business.
Yeah.
How are you thinking about this today? It seemed like a perfect thing in 2021 to bolt on a low margin payments business to anything, didn't it?
Yeah, I mean, I would say, to me, when I hear the term low margin SaaS, that sounds like an oxymoron.
I think it is an oxymoron.
Software is supposed to be high margin.
The
insight that made Bill Gates the richest man in the world is he realized he could mass produce software, so at a low cost, right? Because,
I don't know how we got away from that.
Right, because
you put a floppy disk or a CD-ROM, you print it, you distribute it to 10 million people, and it's cash, right?
Right, it's specifically, it's an IP business, meaning that all the expense in creating the software goes into producing the first instance or the first copy of the software.
Yeah.
Making additional copies of it is on the margins free. And so the more of it you can sell, the more lucrative it is. That's the definition of gross margin. It's almost like a perfect gross margin business. There's no incremental cogs to producing more copies. So as soon as you get away from that model, you're getting away from what is unique and special about software. And I think, I'd say the payments businesses, maybe, or fintech would be one aspect. I think the other one was just all these like tech-enabled businesses that had that was software, but it had a major physical world component. And those businesses just got clobbered in the last few years. And we've just kind of realized, we didn't do a ton of it, but I've come to realize that software businesses that have a physical world component, it's very, very difficult. You need a founder who is a true like 10x operator to make those businesses work.
It's 3 times more complicated minimum,
yes,
right?
Many times more complicated. You really have to pay attention to your gross margins, and most founders don't have the experience to really do that. The nice thing about creating a software startup is it's very forgiving in terms of if you're not operationally efficient. It's certainly more forgiving. I mean, look, it's not a good place to be if you're not operationally efficient, but if you're good at product and you're good at sales, you don't have to be the world's greatest operator to make a software business work. It's mostly about basically finding product market fit and selling, and all you have to look at is the top line and the bottom line. You can even ignore everything in the middle if it's right,
your
exactly.
software, right?
But if you're like delivering food, you better be a world-class operator, or you will not make the margins of that business work.
What about like a Toast? Would you invest in Toast today?
Because it's like a very low margin.
I mean, Toast is 12 billion plus value. I mean, but it has hardware that it loses money on.
Yeah.
Then it has services that it loses even more money on. Then it sells to SMBs, hardware and services. But it's profitable now at billions of top line, right, and $1 billion in revenue.
Yeah, I mean,
but it won its category, right?
I would say at the Series A stage, I might miss that company.
I miss it.
Yeah,
too many weird things going on.
Yeah, I mean, it looks really hard.
It was really hard. They were sort of quasi-incubated at Bessemer, and I remember Byron told the story that they told him, whatever you do, don't go into the hardware business. Don't do point of sale. And they said, you're absolutely right, but the 10x, to make it work, we have to own the whole stack, right?
Yeah.
But I mean,
there's always exceptions that prove the rule, but it's just hard when, the thing I look at is there a COGS line in the P&L, and what is in there?
Yeah.
Because pure software businesses shouldn't really have one, but sometimes they do, and sometimes they're misattributed, and then you find out, oh wait a second, this business actually does have COGS, but the finance team buried it and in like an overhead line, and then you find out, well wait a second, this business is actually negative gross margin.
Yeah.
It's like one of the worst things you can ever discover is that your late stage business, which is growing really fast, is actually negative gross margin, because what that means is you've been selling dollars for 90 cents, and so now you have to question if you have to reprice everything, meaning you now have to change your pricing of the product to get out of negative gross margins. And when you do that, you might lose your product market fit. So it's like, you really got to make sure from the beginning that you're properly instrumented on things like gross margin.
Yeah, you had an insight when we caught up the other day, just for folks here, that I thought was simple but pretty profound. If you're not an 80% gross margin business, if you have other stuff,
right,
your margins are probably much worse than you think.
Yes.
I just went through this with the startup. I invested in best team, best everything, but they have a blended business. And I was like, your margins can't really be 70. And they came back, well, they're 55 now, right?
Right. And this is what I mean by like, if in pure SaaS businesses, there's a lot of forgiveness for not being operationally like the best.
Very sloppy on everything.
Yes,
there,
exactly.
Right?
But as soon as you're in a world of kind of, again, these physical world components or these like cogs, if you do something like misattribute a true cog to overhead, to your G&A, for example, like that can be fatal, because what will happen is you'll think everything's great to your Series C, and then a really sophisticated late stage investor is going to point out, wait a second, that expense belongs in your cogs, and all of a sudden your gross margin turns negative, or it goes from 55 to 10%.
Yeah, then you're not.
And all of a sudden, it's like, wait a second, you don't even have the business that you thought you had.
Yeah. Let me get this next one. High level one. This is a term that we'll come back to later. Have we bounced off the bottom? What are you thinking in general yourself or a craft? Where are we versus a quarter or so ago?
I think we bottomed out.
Bottomed out?
I think we bottomed out in the last few months. Certainly from a public markets valuation perspective, we certainly have the Nasdaq's up like 30% this year.
Yeah, that was the good investment. Leave your money in QQQ and call it a day.
For now, a lot of that is based on the market believing that inflation has been licked, it's in the rearview mirror, and we're going to get rate cuts next year. So the market's starting to price in, a lower discount rate on all these growth stocks. If inflation rebounds, then watch out, because the market will sell off. But from a public market standpoint, there has been a recovery, and that tends to trickle down to private valuations as well. So we've certainly bottomed out on the capital market side. I think that for founders, I've started having board meetings in the last few weeks where there's like green shoots, like some companies are starting to accelerate, and it feels like things have kind of bottomed out.
I don't think most folks that have good businesses are saying things are getting worse, are they? Out there, most.
No one's saying it's getting worse anymore. But there's a lot of companies where there's still a lot of deferred pain.
Yeah.
Where they raised huge rounds in 2021, especially. And they've been burning too much money, and things may have bottomed, but it doesn't mean that they're right. And there's still, I think, you're still going to see over the next year or two a lot of companies, run out of money and die, or have to take down rounds or restructure. So there's definitely some deferred pain in the ecosystem that still has to play out.
Yeah, but let me come back to that just to show folks here. Look, I just picked two. I picked two that are kind of representative of what we're going through. One on the left is ZoomInfo, which is kind of like the public leader in pure play sales and marketing. You can see they hit bottom on Q. Actually, it was just like David said. Actually, things held up pretty good last year, right? And then they hit bottom in Q1 and then bounced back, right? And then Zoom is obviously the craziest COVID. It turned out it looked like the greatest beneficiary. It was the greatest non-beneficiary of COVID, right? And they finally kind of returned to limited but real growth in new bookings. So those to me, like if you look at the most impacted, if they're bouncing off the bottom, maybe it's a dead cat bounce, right?
Well, but, the companies that were doing, that were accelerated by COVID, like food delivery and e-commerce and Zoom, they're in like kind of a little bit of a different bucket, I think, than just like the software bucket. And so those are the ones I'm talking about.
Yeah. One more quick one on this, just because, just your thoughts. I get burnt out, everyone saying how horrible it is on the Twitter and the internet, or X, because not everything's a downturn.
Right.
Like the overall consumer economy is pretty good, and if you look at, I picked Toast, notwithstanding our margin question, and I took it Monday. We're having Iran, the CEO of Monday, come in a couple hours, interview him. Like Monday sells to normal companies, okay, and and there was no impact at Monday. I mean, minimal impact, right? And so we have this. How do you think about it? There's like this microcosm of SaaS startups that sold to B2B SaaS startups selling a fungible sales and marketing product that it felt like the world ended, right? And then there's real world companies where impacts were so is this a downturn, or what did we actually just go through?
Well, I think you're picking two of the best least affected companies.
Yeah, I could pick Mongo or Snowflake and a few others, but point taken. Right?
Yeah, what I can tell you is that my sort of view, based on the casual empiricism of sitting in a lot of board meetings, is that things like sucked for the past year, and a lot, because I think a lot of startups do sell, not just to other startups, but to other big tech companies or the early adopter type buyers. And a lot of these companies were going through layoffs, and so they were reducing the amount of seats they needed to buy.
Yeah.
So even the startups that were good at getting renewals were renewing at, they were getting seat contraction as opposed to seat expansion.
Still happening.
Still happening. And that was a big change, because for the last decade plus, seat expansions has been this huge wind at our backs. Yeah. And all of a sudden, seat expansion, 120% has turned to 80% in terms of the expectation for the renewal. So that's been a big problem. The other thing I'm seeing is that there's a lot of categories that are merging right now. Like you look at like sales enablement, for example. We thought there were 5 or 6 different categories of sales enablement. They're all now trying to get into each other's business.
Yeah.
And buyers are starting to sharpen their pencils and say, well, we just need one of these. And I think that's going to happen in a lot of software categories. So the buyers are getting more discriminating. Everyone's looking to cut costs. And I think it's like a pretty tough period, actually. I mean, I describe it as a software recession. I don't know why the rest of the economy has held up as well as it has. But from the point of view of if you're in the software business, we've been experiencing a recession over the last year or two.
What do you I've started to go into kind of an ass-kicking mode related to this, which is, look, this happened, right? So it was a tough year, but aren't we lapping that? Shouldn't everybody do like a little bit better the next year than they did the last year? Do you get an excuse to not at least do better than last year if you were heavily impacted?
Yeah, I mean, I think that I'd say the last 5 quarters have just been like every board meeting is reforecasting down. But I think, like I said, the last few weeks, it feels like things have started to turn up a little bit. So if you're still reforecasting down 5 quarters from now, then I'd say you're screwed. Like the next year should be better. Yeah. But the old saying goes, it's a escalator on the way up and elevator on the way down. So we just had the elevator on the way down. Now we're starting to build back up. It's not like it's going to bounce back to just where it was, in late 2021. It's just not.
Now, it'll happen. Take another 20 years.
Yeah.
Right?
It's like Bill Gurley describes it as kind of a sawtooth pattern where things kind of go up with little corrections, and all of a sudden there's a big correction that starts to go back up. So we're kind of like sawtoothing our way back up, but it's just never going to be like it was in 2021. I mean, that was like the biggest bubble since the dot-com bubble in 1999.
It was because the smart people bought into it.
That's what always happens. Psychology is really powerful.
It went on too long that even the cynics, you have to play the game on the field, right? Yeah. So do you want to sit out the game for 2 years when, there were huge cash exits? It was. Yeah. There were cash exits in 2000, 1999 too, right? I mean,
the ZERP bubble, if you want to look at it that way, had been building for 15 years. It's a long time, and so people just kind of started taking it for granted that interest rates would always be this low, that capital would always be this available, that valuations would always be this great. But it wasn't just us. I mean, look what's going on in the commercial real estate sector. They are just getting their faces ripped off right now. You're going to see a lot of...
More to come.
Yeah, you're going to see a lot of CRE bankruptcies in the next 18 months.
Should we... and I want to hit a few other... I want to hit this one for fun. But related to this bankruptcy thing, and I know it's very visceral when you're on board meetings and all that other stuff, but should we really care if some of these overfunded unicorns fail? Does it really matter? I mean, there's so much on social media and the media, but if it's all ZERP, does it matter? Does it matter if 20 or 30% of the 1,100 unicorns go under? Is it such a tragedy?
Not to any of you guys if you're founding companies. Who cares?
Yeah.
It really only matters to the founders and employees and investors of those.
I don't mean to be callous to the employees.
No, it matters a lot.
But at a meta level, right? The world hasn't ended, or
no. I mean, and look, I think that software is not going away. I mean, software is only going to become a larger and larger part of the economy. There's no way that it becomes a smaller part of the economy. the business environment is always changing. There's always these new platforms like AI. So if you're a founder who has a great idea for starting a company, no, it doesn't matter to you. I mean, start your company. It doesn't matter that some overfunded unicorn, like, is basically, a zombie.
Yeah, I mean, I don't mean to be, I didn't mean to be uncaring about employees that are impacted, but at all. But at a meta level, we take so many cues from VCs, right? And yeah, as a VC, it pretty much sucks if you got 10 unicorns you got to ride. I'm sure it's not fun to work at Tiger or SoftBank today, but for the world, I just don't. I think it's overdone.
Yeah.
It's
Look,
overdone,
I founded Yammer in the wake of the 2008 great financial crisis.
Didn't stop you.
It didn't stop me from. Yeah, it was, and it turned out. I mean, it was. By the way, it was really hard to raise money. I think we only had like one term sheet at the Series A and Series B.
Is that true?
Yeah.
Even as the COO of PayPal, you got one term sheet?
Yeah. I mean, it was not easy, but we did it. And PayPal was mostly created after the dot-com crash. It was founded before, and thank goodness we raised a bunch of money before, but the company was built primarily in the wake of the dot-com from 2000 to 2002. So I think building a company during downturns is a great time because the war for talent is less intense, so recruiting gets a lot easier. It was getting insanely hard to recruit anybody in 2021.
Yeah.
And startups couldn't really compete with big companies, which were, giving huge salaries to, so that gets easier. Also, when you are operating during either a downturn or just a less frothy period, there's less competitors who get funded. Like in 2020 or 2021, as soon as you would come up with a great idea and start a company, there'd be like 5 copycats who would get funded. So I think it's generally, and if you look at the history of like great venture returns, it happens from vintages when you're not like obviously in a bubble. So this is a much healthier place for the ecosystem to be.
Yeah. Okay, this one, the burn multiple. So every investor update, I mean, I think you coined the term. If you didn't coin the term, we'll consider you the coinifier of the burn multiple. Every investor update, I get this metric. I think of you every time, the burn multiple. And I agree with you on close to 100% of things on SaaS, but this one I want to challenge a little bit, only because I think it may have taken on a life of its own beyond what you intended, right?
Right.
Which is I see founders that are maybe burning a little too much, thinking their burn multiple is okay as they're slowly driving their car off the cliff, right? They're slowly driving it, right? And so when you think about this today, what is all this? I know what we're trying to simplify a lot of things here. How do we think about burn multiple in 2023, 2024?
Yeah, I think I wrote this blog post called The Burn Multiple. I think I wrote it in early 2020. So
early 2020.
Yeah, it was about 3.5 years ago. Actually, I think it was when there was like a 3-month kind of COVID swoon period in the market.
Might have been 6 weeks, but we'll call it 3 months.
Yeah. I mean, basically, everyone thought the world was ending because of COVID, and then the Fed just started airdropping money. So it was a very short-lived, and that's when the bubble began, the super bubble began. But in any event, I wrote this there because I thought that it would become very important for startups to think about their capital efficiency, and they weren't. And now the message really matters. So but in any event, in terms of, well, sorry, what's the question again? I'm losing.
Well, how do we just now? I feel like today, so that window, right, was an area where efficiency was incredibly important, right?
Yeah.
Then we went through an area where it was only important as a game until the next round, right? Now we're in an interesting world where actually, for the first time, all the public SaaS companies are efficient. Monday went from -15 to like plus 20% non-GAAP operating margin in 15 months. Mongo just flipped 15 points. Salesforce is approaching the rule of 50. It's already at the rule. I mean, the level of efficiency in the public, it's jaw-dropping. They basically just froze hiring. It sort of worked.
Yeah.
But so we're in this new area of more efficiency. So what's the guidelines for founders today, right?
Okay, so let me make 2 points. So the first is why kind of come up with this new metric of burn multiple as opposed to using things like CAC or CAC payback, things like that.
Yeah.
I think it's important is that what I was seeing in metrics like CAC is that if the finance team simply misattributed a certain expense, then like it would make the CAC payback look great.
Everyone's got a great CAC.
Yeah, exactly.
Every startup
it was,
has a great
it was
CAC.
just way too easy. And I'm not saying they did it on purpose, but you know, you just ask the founders, well, is your entire marketing team, including the communications team, in CAC?
Yeah.
And they're like, no, I thought it was just salespeople. So there's just too high a chance that CAC was, or magic number is even the worst version of this. Like no one knows how to calculate it. It was constantly miscalculated. So the beauty of burn multiple is you just take your entire burn in a given quarter or year and you divide by the net new ARR. And so there's like nowhere for people to hide. It's like it just captures everything. And it's a measure of efficiency. Now, the second point is that I created these like rules of thumb to make it really easy for founders just to quickly diagnose whether, this is a good thing about the metric, right, is like in like 30 seconds you can figure out if you're good or bad, you know, every board meeting. But it is true that the standards for what is a good burn multiple change over time. So, and I say this in the blog, but I don't like quantify it. If you're a very early stage startup, like let's say pre-Series A, your burn multiple has to be bad because you're doing all this R&D and you're just starting sales. So your burn compared to your net new ARR, it's going to be a really high ratio. And
If you're funded.
What's that?
If you're funded.
If you're funded, that's okay. But what should happen over time is that your burn multiple, which is just your burn divided by your net new ARR, it should be going down. And obviously, by the time
I think that's the point that folks miss.
That's the point. It should be going down. And so, like, if you're a late stage company, you're like a growth stage company, like your burn multiple should probably be 1 or even less. Meaning, let's say you add 20 million of ARR, net new ARR in a year, you shouldn't probably be burning more than $20 million. Like, you know, and then by the time you get to be public, obviously, ideally you'd be profitable or cash flow positive, in which case your burn is 0. And hopefully your net new ARR is a big number. So 0 over a big number, it's 0. So your burn multiple should be trending down towards 0 over time. It can start at the seed round at a high place. By Series A, it's okay to probably be at 2-ish. Growth round 1-ish. Public company 0.
Yeah, it's a good. This idea of how it trends maybe was in the post, but it's not in every investor update I get. I think where I see it get corrupted, if you're lucky enough to have raised funding, right, is as you cross 10 million, somewhere around that $1 million a month, your burn can grow out of control, right? It can grow out of control the day after demo day, OIC. But there's this moment in time, it's starting to click, right? You're hitting 10 million, you're growing 100%, 120. If you're growing triple digits at 10 million, you got something good, right? Yeah. And if you look at your burn multiple, and I'm like, well, it's 2.4. David said it was suspect, but I'm not in bad. But 2.4, when you're adding 1 million of new bookings, that means you're burning 2.4. I got my math right. You're burning over 2 million a month, right? And so it can sneak up on you. You go from 600 to 800 to 1 million, and that's where I see it. Just when it gets good, your burn multiple can get bad, right? Yeah. If you're not that's where I think people misunderstand it, right?
Yeah. Well, also, so what happens is that when a startup creates its forecast for the next year or the next quarter or whatever, if they want to scale up or hit a greater level of ARR, they typically have to invest. They hire a bunch of salespeople, they train them, there's ramp time. So you know what your costs are going to be, but your net new ARR is basically a prediction. And if you miss, your burn multiple can go from like a forecast of 2 to like 5.
It shocks founders all the time, doesn't it?
But that's a good reason to be looking at the metric, is to like, it does jolt them when they see, wait a second, our burn multiple is horrible this quarter. I gave a few talks that are to our portfolio companies that we later put on YouTube as we were going into this software recession in 2022. And what I said is, do not let your burn multiple go above 2, because we're going into a tough period. It's more likely that you're going to miss than exceed. And if you miss, your burn multiple is going to go off the charts. It's going to be even worse
than you're planning, right?
Yeah, so 2 is the absolute max that your burn multiple should be going into this like tough period. And so anything above 2, you're in the danger zone already.
Okay, that's a good summary. All right, one thing I want to make sure we hit, let's skip that for a minute.
Yeah.
A little bit of a plug, but
yeah,
you've had some success. Founded Yammer, founded a few other, movie producer, 3.5 billion under management, PayPal, others. So you're going to start another company?
We did.
You did.
We're launching this today. We announced it today. I just tweeted it out. This was previously a free tool that we gave out to our portfolio companies first, and then we kind of published it. And the way it's SaaStr, and it's a dashboarding tool that's built specifically for SaaS startups. And the way it works is you just connect your data sources, like Salesforce or HubSpot or QuickBooks, or you could upload spreadsheets, and you just connect those data sources, and then we basically give you all the charts and dashboards you need and should be looking at if you're a SaaS company. There's something like 70 metrics that we just auto-calculate for you. And then there's a setup process where we've identified like hundreds of edge cases where the data doesn't properly translate from HubSpot or Salesforce or QuickBooks or whatever. And so its implementation takes about 30 minutes. And then, so we'll help you get it set up, and then you can customize the dashboards. This will save, I think, SaaS startups a ton of time. There are other dashboarding or business intelligence tools out there, but none of them are custom built for SaaS companies. So what happens is you have to hire like a data analytics team, and then they're going to take all of these data sources and put them in a data warehouse. They're going to have to clean them up. Then they're going to have to write a bunch of formulas in SQL for all the SaaS metrics that you think you need. You're going to forget about half of them, and then finally you'll get your dashboard in like Looker or Tableau. This just replaced all of that. It's a 30-minute process. Connect your data sources. Boom, you've got everything you need, and you can customize it from there. So I think the idea here is that by verticalizing a business intelligence tool for a particular industry, we can just give you a level of convenience and value that just wasn't possible with a broad-based generic business intelligence tool. So that's what SaaStr is. The history of it is this just started as a spreadsheet that we would give to companies that were applying for, basically they wanted to raise money from craft. So we just gave them a spreadsheet saying, fill this in, because they weren't giving us their metrics in the right format.
Got it.
So we're like, here's the right format. So we give them the spreadsheet. The spreadsheet would spit out the charts so they could kind of see what they were giving us. And they're like, whoa, this is really good. I wish we had this instead of just doing it ourselves. So then we basically put it out there as a free website that they could use. And then the aha moment was we started seeing SaaS companies using it as their dashboarding tool, meaning not just when they ran a financing process, but we had 500 companies that were just using it as their dashboarding tool. And we're like, okay.
They'd applied where you could apply to craft to get reviewed, and they would use the output as their screening, as their reporting tool.
Yes, but not just. But again, the aha was they were using it not just when they need to raise money.
No, every month.
But every month or for their board meetings, and we're like, okay, the world actually needs a dedicated SaaS dashboarding tool. And the more we started thinking about that, the more excited we got. And look, I'm like a co-founder, but the CEO, the real CEO founder is Ethan Ruby, who is our partner for analytics at Craft, and he's been in the weeds of taking all the data from startups and realizing where all the edge cases are and where all the formula errors are and where the data always gets screwed up, and he's been cleaning it up. And so he's productized the work that he's been doing with hundreds of companies, and he and his brother actually are the main founders. And now we're splitting this off into its completely separate company. And I think we can make this the standard for SaaS companies,
So I can go today, SaaSgrid.com, not .ai.
What's that? No.
We'll come back to the AI piece later. I can do this. I can hook it up. I can hook up my CRM, my QuickBooks, and I can start getting these same analytics to 500.
Totally.
Pretty good deal, right?
Yeah, and it's free for any SaaS company. If you're under $1 million of ARR, it's totally free to use. We don't charge you till you hit $1 million of ARR. So I think you'll find that if you use this, it's going to simplify your lives a lot.
Cool. All right. I'd love to go for another 45 minutes, but let's thank David. This was really great.
All right. Awesome.
Thanks, man.
Yeah, great.